Thank you guys for joining this morning. I'm going to admit on the front end that I am not a Zoom whiz, despite the last 9 months to become more familiar with the technology. So bear with me. I'm going to start by trying to share my screen and see if I can do that successfully here. I'm assuming you guys can see that. Tommy, okay, thanks, Tommy. So today's class is on taxes and tax rules and opportunities specific to realtors. What I plan to do is just go through the content and then have time available for questions afterwards. I don't know what else to do. I prefer for these to be more interactive, but that's not, this isn't the best technology for that. So I think in terms of questions, if you'll make notes of questions, and I don't know what else to do other than suggest you type them in to the chat box as we get closer to that time through them. We can unmute and mute, but I think coordinating that would be a hassle. So I'll start with the content here and hopefully have time afterwards for classes. Now, a couple quick points. I did this class last year, and there's not a lot of content changes from last year, partially because there haven't been a lot of tax law changes or planning opportunities that have come through as a result of last year. Most of the tax rules and changes that you may have heard about or seen relate specifically to COVID circumstances. I do plan to address a few of those on the front end. So if you were here last year and took good notes, you might want to wait for the first 15 minutes and listen to the COVID specific things I had planned to talk about. And then if you want to drop out, obviously after that, you're welcome to. Or if you just find my my monologue to be so thrilling, you're welcome to stay for that. Secondly, this will be a high-level discussion. There's a lot of technicalities, you know, in for instance, in what you guys do with your contracts, et cetera, and what I do and others do with tax law. So I'm trying to touch as much content as I can, but it is at a superficial level. Not everything will fit for each realtor. I know that probably doesn't need to be said, but I do want to at least get that through on the front end. So without anything else, I'm going to go on and just kind of start jumping into the presentation here. And like I said, have some time at the end for questions. So I'm going to start, I apologize, bear with me. I'm trying to organize my screen here so I can see my own content. I'm going to start pretty basic and high level with how are realtors taxed, or as I like to say, harassed. Many of you who've been experienced realtors already know this, but anyone who's new on the call or new to real estate, this is probably good for you to hear. Basically, realtors are treated as contractors. So everyone who receives earnings of any sort in this country, for the most part, is subject to income tax. 5% Mississippi and up to 37% for last year, at least, from the IRS. So I don't touch much on that in terms of this overview. What I do want to touch on is the fact that you guys are treated as contractors in most cases and not employees. As contractors, you're subject to what's called self-employment tax. Self-employment tax, if you've ever been an employee, is basically the equivalent of Social Security and Medicare tax that you had withheld from your checks as an employee. However, whereas from your checks as an employee, you only had around 7.5% withheld. With self-employment tax, as a contractor, you're treated as both the employer and the employee. So you're responsible for both the employee's portion of 7.5% and the employee's portion of close to 7.5%. So you're subject to close to 15% self-employment tax, which goes to Social Security and Medicare as a realtor. And that's not on your gross. In other words, that's not off your total commissions. That's after all expenses are accounted for, what we call your net income or taxable income. None of your personal deductions lower that, though. So if you have a mortgage or property taxes and you're used to taking deductions for those do not lower your self-employment income. So when we work with any of our clients who are considered contractors and self-employed, one of the points of emphasis is trying to ensure we maximize deductions that are available to lower that 15%. Like and you lower your income, it lowers the income tax as well. But that 15% self-employment tax is what typically surprises our clients. You'll see on the right there that 12.4% Social Security is capped. There is an earnings cap on Social Security of about 138,000. So after that, you're only subject to the 2.9% Medicare tax, but it's still an additional tax relative to what others might be paying. So I do want to touch on the COVID-related tax news, some of which has just passed within the last few weeks, some of which passed close to a year ago. Many of you would have been impacted by this. But by the way, as a side, when I taught this class last year, I think we had just had the tornadoes in DeSoto County. And I remember possible tax implications for those tornadoes and what a terrible time that was. This hit me the other night when I was reviewing the presentation that little did we know what we were in store for after that. My parents were directly impacted by the tornado and the storms. I had many friends and clients who were. We've all been impacted by the last 9 months or so. First thing I have with several exclamation points here related to COVID tax news is PPP, the Payroll Protection Program, is not taxable. That, for those who are unfamiliar, you were eligible last year, starting in about April, to apply and receive essentially a government loan, is how the government phrased it, equivalent to about 2.5 months of your self-employment earnings, or if you had employees, 2.5 months of their payroll, with certain caps and throttles and things like that. Congress's original intent was for those funds to not impact taxes, to be basically a tax neutral event for its recipients. So they basically said the PPP funds you receive are not taxable. Well, the IRS came out a few weeks or months later and basically said, okay, well, the receipt of the funds themselves may not be taxable. However, you're not allowed to deduct anything that you use the funds to pay for. And there were specific rules about what the funds should be used for, primarily related to paying yourself if you were self-employed and paying your employees, in addition to some other expenses. So essentially with the IRS saying that those funds, or the use of those funds and the expenses they were used to pay are not deductible, they effectively made PPP taxable. Well, in December, I don't remember, right after Christmas, Congress came back with another stimulus act here and came through and finally said, all right, IRS, not only is the receipt not taxable, but we're going to allow the deductions to be deductible. So effectively what happened is PPP, now if you received it, you don't even claim it or account for it on your tax return. The funds aren't taxable. The deductions for which they were used, the funds were used, are fully deductible, and you basically come out with a freebie from the government. So great news on that front. That was something a lot of my clients, any small business, particularly if they had employees in this area, participate in that program. That was a huge, huge freebie and win for everyone. They have started a PPP, or they are starting a PPP draw 2, is I think what they're calling it. It's much more restrictive to receive. Just because you got PPP last year doesn't mean you're eligible this year. There's certain decreases in your income that you have to show and account for. And from what I have seen in discussions I've had with realtors in the area and real estate firms, most of you likely won't apply because real estate was one of the few industries last year that, not few, many of the industries in this area were very blessed, boomed. Real estate's one of those that boomed. So I don't know of many realtors who necessarily had a decrease in revenue in 2020 relative to 2019. But if you did, you may want to talk to your bank about whether you're eligible. Also, as part of the CARES Act passed last March, they increased unemployment benefits. They additional $600 monthly payment, and they made self-employed individuals eligible for those. Now, typically unemployment only applies to employees who are laid off or leave under certain conditions. It's a state paid benefit. But because the The government opened up a portion of those benefits to what's called gig contracts, contract workers or those who are self-employed. Many of you may have received the unemployment benefits, that at least the additional $600 payment that was eligible. Those unemployment benefits are taxable. And I hope that was communicated to you on the front end. You probably were asked whether you wanted any income taxes withheld, but you will need to account for any unemployment benefits received on your tax return. Last year, as part of the CARES Act, also was special rules for retirement account distributions. Now, generally speaking, if you're under the age of basically 60 and you pull money out of a retirement plan, it's subject to income tax, but there's also a 10% penalty tax that's charged on top of that, unless the funds are pulled for special or specific reasons. That 10% penalty tax gets my clients every time. Oftentimes when you pull funds out of retirement for special reasons or financial reasons, whatever it might be, you're asked if you want to withhold money. I see many of my clients withhold at 10 or 20% and don't know to account for the extra 10% on top of it. So all of a sudden, a retirement distribution that may normally be taxed at 20% is all of a sudden subject to 30% taxes. It's a real hammer in terms of a real disincentive, as it's meant to be, from withdrawing retirement funds. Last year, 2020, distributions from a retirement account under certain circumstances, and one of the big ones is related to COVID. And that's pretty broadly defined. I'm going to go over a couple of points on it, but those distributions are not subject to the 10% penalty. You could have withdrawn up to $100,000 from your account last year and not have it subject to the 10% penalty if it met certain requirements about COVID. You also have an opportunity that if you pull those funds out, say you were in a little bit of financial bind, as many of our clients might have been because of lockdowns or slowing down in their industry, you had the opportunity to repay that for over 3 years. Normally, you pull it out. If you don't put those funds back in 60 days, it's taxable. The IRS and the government has passed rules saying you have 3 years to pay that back. But should you choose not to pay it back, instead of taking the tax hit all in the first year, all on your 2020 return, you have the option of spreading the taxes out over 3 years. So basically, you pull the money out of a retirement account, such as in a former 401k with an employer, or maybe you have a SEP. If it's COVID related, you choose to keep that money. You don't pay the 10% penalty, number one, and you have 3 years to basically spread that income out over your tax return. So it's a much smaller tax hit potentially because you're not realizing the income all at once. Now, in terms of distributions and how they quote unquote relate to COVID, this is pretty broadly defined, which is another way of saying IRS hadn't fully flushed this out yet. But what we have seen are instances such as if you were on leave, or you were diagnosed with COVID, or a member of your household was diagnosed with COVID, or you had financial hardship as a result of COVID, maybe a layoff or with you or a spouse or someone in your household. Those are instances or examples of what qualifies as COVID eligible distributions. The other COVID related taxes, now there's a lot, there's a tremendous amount in the bill, but I tried to pick some items that would potentially, I anticipate, impact you guys. You, as you're preparing your tax returns this year, with yourself or a tax preparer, need to discuss whether you as a self-employed individual are eligible for a reduction in your self-employment tax as a result of COVID-related quarantines. Basically, as part of the CARES Act again last year, if you miss time from work, or someone in your house missed time and you had to stay with them, or your office quarantined you, and this is important, and you were unable to work, or your spouse was unable to work during that time because either you or him or her were sick, or a child was sick and you were having to help care for them, or a child's daycare or school centers closed and you had to help care for the child, you are eligible for a reduction in your self-employment taxes on 2020. It is still being shaped. There's tax forms out there specific to this, but that's something that's it's going to be very technical, a technical calculation, and beyond the scope of this class to go into a lot of the details. But what I want you to leave with here on this is that you, as a self-employed individual, could receive a reduction in your self-employment taxes if you were unable to work due to you being sick, someone in your house being sick, or because daycares or schools may have closed, or you were under quarantine. I'll use myself as an example on this, though. And my son contracted the virus in mid-December, so I went under a 10-day quarantine leading right up to Christmas Day. I am not going to take advantage of this, even though I'm self-employed, because I was able to work. Maybe not quite as efficiently, but I was able to work with my office and conduct client meetings, phone calls, things like that. So I don't feel I'm eligible. Had I been sick instead of my son and unable to work, even if it was just for 4 or 5 days, I would look at taking that. The fact that I wasn't sick and was able to work remotely, I feel disqualifies me. Had I been sick, had I been down in bed for 4 or 5 days or 2 weeks, as I've heard some of my clients have said, that's a different story, and I certainly would look at taking it at that point. So those are really some of the COVID-related tax issues that I think are beneficial to this group, and that, again, I would want you to think about or have in the back of your mind as you're looking at your 2020 tax return. I'm going to shift gears now and talk about tax law revisions from 2018, that these have been in place now for 3 years, but these again impact realtors and real estate brokerage firms and are just important to always have reminders about, or if you're new in real estate, you really need to keep in mind. One of the big changes, and this helped everyone, was the government in 2018, the end of it, lowered tax rates and expanded the tax brackets. So there's two benefits there. One, the tax rates lowered, but two, expanding the brackets essentially meant that you paid lower taxes longer at certain income levels than you would have previously. So the way our tax system works is you progress up. You start at about 10% and you go all the way up to 37% in taxes based on your income. Now, that doesn't mean all your money's taxed at 37%. You still have a portion taxed at 10 and then some at 12 and so forth and so on. By expanding the tax brackets, what that means is more of your income was taxable at 10%, more of it's taxable at 12% before you graduate to that next tier. So that was a big win. Secondly, they disallowed entertainment. Now, I have many clients who might have football tickets, season tickets, and they would deduct a portion of them for taking clients to, Ole Miss games or Mississippi State games, or if you're like me, I'd love to go to an Alabama game. Those are no longer allowed. Meals are still deductible at 50%. But the entertainment aspect, take a guy golfing. The golf, you might have lunch beforehand, that's deductible, the golf is not. There's also a cap on state income taxes, and this includes real estate taxes. It used to be you could deduct as much as you qualified for or paid in real estate and state income taxes. Now there's a cap of $10,000. Doesn't impact us in this area as much as other states. Mississippi's only a 5% rate. California gets up to 13%. So some of the higher tax rate states were really hurt by this. Then the other big one, and this is probably the most business-friendly tax law change, small business-friendly tax law change I have seen in the 20 plus years I've held a license. It's called qualified business income deduction. Basically, in summary, your self-employment earnings after expenses, you're allowed to exclude up to 20% of your self-employment earnings from income tax. Now, they're still subject to self-employment tax, which again is Social Security and Medicare, but they're not subject, up to 20% is not subject to federal income tax, still subject to Mississippi. I've got a note there about it varies by IRS defined business types. What that means, if you're structured like as an LLC or taxed as an S corporation, it may be treated a little differently than someone who's just structured as a sole proprietor and includes everything on their personal tax return. But that's some of the technicalities that you need to look at, or you have already looked at if you've been filing using this. There's also income phase outs, $160,000 for single taxpayers, $321 for married. That doesn't apply to all industries, and that doesn't apply to all structures, but that's just something to keep in mind is once you get to certain income levels, you're going to receive less and less of that benefit. So what can you do as a realtor? Well, one of the things I always like to touch on, particularly those who are new to the industry, is what I call inside business deductions. So those that are, when I'm saying inside, basically those that are specific to realtors, and not just realtors, obviously, but those that you're paying as part of your business: advertising, brokerage fees, E&O insurance, office rent, continuing education. Accounting fees are fully deductible. So your tax preparer as a business expense, not as a personal expense any longer, but as a business expense. So some of those are pretty obvious. And most of my clients who are realtors incur some or all of these. So those are all fully deductible as a result of being a self-employed individual. What about these? Well, entertainment's in the middle of the list. We touched on that. Entertainment is no longer deductible. Meals have traditionally been limited to 50%. And that's always been the case, although there were exceptions. That was codified or solidified in the 2018 tax law changes. I do want to say that for 2021, not for last year, but for this year, meals now, certain meals under certain circumstances, business meals are eligible for a full 100% deduction. They need to, and that's eligible for self-employed individuals as well, not just businesses. So some of the rules on that is you have to eat at a restaurant. That's, I think, how they justified passing this is basically trying to encourage us as a nation to get out and eat in restaurants again if you haven't already been doing so. One point to remember: that does not help you last year. It will be something that helps you guys this year. So meals, entertainment, home office, that is a deduction. I get that question a lot that you can take. It's not incredibly valuable. And what I mean by that is it's based on square footage. And so in other words, you pay a home mortgage, you can't deduct the home mortgage as part of a business expense. You can deduct a portion of it based on the percentage of your house that's used as an office. It also brings in opportunities such as utilities, homeowners insurance that you can't deduct already as an itemized deduction. So I get the question a lot: is this a red flag? I have never seen that as a audit trigger. Now, that said, the rules say dedicated home office space. So if you've got a guest bedroom that you've got a desk in and you're working in, under audit, that may not pass muster. That may not be a dedicated enough space to qualify as a home office. If you've got an extra bedroom that basically is a desk and printer and whatever else you're using to support your business, in my opinion, even if there's a closet with winter coats in there, I still consider that a home office. Paying for repairs and expenses to facilitate a closing, I consider those as fully deductible expenses. I see that frequently. You get to the end of a deal, there's an extra repair that's identified. Neither party's willing to budge. You said, look, I'll cover the plumber. He can come out and replace that valve or whatever the case might be. Those to me are necessary expenses for you to facilitate and close a sale. And as a result of them being necessary for that, I consider them deductible expenses. And again, just a reminder, accounting fees are fully deductible. What about vehicles? This is oftentimes the largest deduction I see for our realtor clients. Now, you're eligible to deduct vehicles based on mileage. So you drive 15,000 miles a year for real estate, you have 8,000 miles personal. That 15,000 miles that you drove for real estate is deductible. And the way it's calculated is you apply the mileage rate that the IRS publishes every year. I think for 2020, it was 57.5 cents. And that you multiply the miles by that 57.5 cents. Let's say it's 10,000 miles. That's $5,750. That is a fully deductible expense to you. Leasing vehicles, certainly leases can be deducted. Again, it's as a business use percentage of the car. You use the car 80% for real estate, as I know many of you do. Probably some of you use it for 100%. The percentage use is what's allowed, even under a lease arrangement. You're also eligible to deduct the actual cost of the car through what's called depreciation. Now, basically what depreciation is the IRS saying will allow you to deduct the business use of your car over 5 years. In addition to that, you can deduct actual costs associated with the car, such as gas, maintenance, insurance, etc. Those deductions are not eligible if you take mileage. If you take mileage, it's all you get. If you take actual costs, then it frees up the ability to take gas, insurance, things like that. Now, I said over 5 years. There's also special rules out there and available for, especially for larger vehicles, where you can deduct up to 100% of the cost of a car new to you. That doesn't mean it's brand new, it can be new to you, up to the cost of a car the first year. So many of my clients utilize this, especially once they're established. If they've had a real good year, as I know many of you did, and you bought a vehicle at the end of the year, you would want to consider whether it makes sense to continue taking mileage or to take a one-time write-off for the cost of the vehicle. Couple points about that. I find, probably given the amount of miles you guys drive, that if you keep a vehicle over 5 or 6 years, you probably come out ahead over that time. In other words, you deduct more costs if you take mileage. But there's no 1-year opportunity for writing off the costs of a vehicle if you take mileage. So many of our clients will look at taking the full cost of a vehicle that they purchased in a year if they've had a real good year, and dramatically lower their taxes that year, knowing the trade-off is you may not receive as much deduction the next 3 or 4 or 5 years because you've already written off the cost. Now, you're still deducting maintenance and fuel, but you're not deducting the actual cost of the vehicle any longer if you take that 1-year write-off opportunity. It's just a decision that you should make, if you're working with a tax preparer, to consider what's the most advantageous. The only other negative, though, is if you take the depreciation and write off a vehicle at cost as opposed to mileage, and then in 3 or 4 years you trade that vehicle in for a new one, you have to reclaim some of what you wrote off that first year. So let's use an example. You buy a vehicle for $50,000 in 2020. You write it off in full in 2020. In 2024, you go get a trade-in for $25,000 on it. You have to reclaim $25,000 of that initial write-off. So you've got to keep that in mind. Now, that write-off on the back, that income on the back end is typically offset by the newer vehicle. Usually we have clients trading in a vehicle and getting a new vehicle. But it also can get you caught in a little bit of a circle where you feel like you've always got to get a vehicle, replace a vehicle with a vehicle because of the, you need that offset. If you plan to do this and write off a vehicle the first year, we encourage our clients who do that to plan to keep that vehicle 4 to 5 years, solely because the longer you own it, the more use or mileage it has, the less valuable it is at trade-in, the less you're going to get hit by this, what's called recapture concept. So again, key notes here: you can deduct mileage, you can deduct actual cost. Actual cost gives you an opportunity for a 1-year huge write-off potentially, but you have to be prepared and plan for the back end hit that comes with recapture. Okay, this probably won't go over as well. I can't. Hopefully you're laughing and being polite, but I can't see or hear anything. But I've got to break it up myself a little bit. So a little bit of accounting humor, and there's plenty out there. My wife, when she can't sleep, she basically has a trick that she uses. She basically sits down, lies down, tries to sleep, and then she says, "James, tell me about your day." As soon as I start, she's knocked out. So, secondly, have you heard the story about the interesting accountant? Neither have I, but if you do hear one, let me know. All right, so we've gone over here COVID, we've gone over tax deductions that are allowed. We now I want to get into some tax planning concepts here. By the way, I see my chat box blinking. I'm basically trying to ignore it right now, if that's okay. I'm going to answer questions at the end. If you're new and weren't here for the very beginning, new to the seminar, I think that's probably the best way to go is go through the content, and then I'll answer questions. If you're telling me how funny I am, please continue to do so, but I won't see that until the end. So in terms of tax planning, one of the biggest opportunities potentially for self-employed individuals is what's called an S corporation. So an S corporation, basically, I'm just going to go over quick advantages and disadvantages. At the beginning, we talked about self-employment and self-employment tax. That self-employment tax, as a reminder, can be up to 15% of your 15% additional tax on your self-employment earnings. S corporations, if you structure yourself as basically a realtor who is an employee or owner of the S corporation, and you run your commissions through that S corporation, it gives you the opportunity to minimize the impact of self-employment tax. And that's because payments from S corporations to you are not subject to self-employment tax. Also, if you have a staff or a team or multiple owners, there's opportunities potentially for group retirement and health insurance opportunities. So again, the biggest one though is that 15% I keep talking about. You can lower that dramatically by having your broker pay you through an S corporation, and then the S corporation pays you. Disadvantages: it limits other advantageous retirement opportunities that you're eligible for as self-employed. I'll talk about those later. Also, it changes that QBI deduction. Now, the QBI deduction that we just talked about a few minutes ago basically is a 20% exclusion from income. That, as coming from your money coming from through to your return from an S corporation, is treated differently than if you just are treated as a sole proprietor. We don't have many realtors that this impacts, but that is a possible disadvantage. Now, the first disadvantage I have listed, there's payroll compliance implications. What I mean by that is the IRS is fully aware of this rule about S corps and minimizing self-employment tax. So what the IRS wants to see are owners of the S corp. So you guys, you set up an S corp for yourself, treated also as employees of the S corp, and paying yourself a reasonable salary. Now, the reason the IRS wants to see that is because as a paying yourself salary through the S corp, you are then paying in Social Security and Medicare tax close to the same rate as you would be taxed on it if you were self-employed. So that's why I say minimize the impact of self-employment tax as opposed to making it completely go away. When we work with our clients on this, and it's not just realtors, it's any industry that's paid as a contractor, we recommend, if this is set up, that our clients also put themselves on payroll and try to pay what's called a reasonable salary. Now, there's no firm definition of reasonable salary. If that were questioned by the IRS, they would probably pull these salary surveys and compensation surveys that are out there and say, well, what's a realtor in this area get paid on average? If they come up with $40,000 after expenses, and they would expect to see you pay yourself $40,000 in payroll. And if you weren't doing so, they could charge interest and penalties and payroll taxes, saying you should have been paying yourself payroll. So I'm going to use an example. Let's say after all expenses, you have $100,000 left over. And I use round numbers because my math is not great off the top of my head. Well, that self-employment tax as a sole proprietor on that $100,000 is close to $15,000 by itself. If you run that $100,000, let me rephrase it. If you run all your commissions and your expenses through an S corp structure, you pay yourself $40,000 in salary. You're essentially going to still pay yourself close to $6,500. You're still going to pay close to $6,500 in payroll. In Social Security, Medicare. However, then if you pay that remaining $60,000 in profit out to yourself as a dividend, you pay nothing in Social Security, Medicare on that. So in my example, and again, if we were together, I'd have it on a whiteboard, but my example is comparing $15,000 in self-employment tax to about $6,500. There's about $8,500 in tax savings there that's available to you. But you're on payroll. That means you are needing to make tax deposits on a monthly basis, quarterly basis, yearly basis. You're needing to do payroll tax filings on a monthly, quarterly, and annual basis. And it is additional work in compliance. So we don't recommend this strategy for new realtors typically, those who are looking to leave the business relatively soon, or those who don't do it full time or don't have a requisite level of earnings to substantiate the extra compliance headaches. That said, the way these are typically structured in Mississippi, this doesn't work as well for realtors who live in Tennessee, but for those who live in Mississippi, you set up an LLC in Mississippi, which is cheap to do. $50 filing fee with the Secretary of State, and you get a tax ID number from the IRS. Then there's a tax form requirement that is you have to fill out, or you get your tax prepared to fill out and file with the IRS. And that tax form basically tells the IRS, I have an LLC and I want it taxed as an S corporation. The IRS accepts that, and then from that point forward, you're essentially running your commissions through an S corp and paying yourself out of that S corp through payroll and dividends and saving some taxes. I'll say this, I speak only to tax law. There might be some rules in the state of Mississippi with the Real Estate Commission that they're not as high on this strategy. And I don't know why. I don't pretend to know why. All I'm saying is that I'm talking to you about it from a tax perspective. We have many clients in and out of real estate who take advantage of it, and it's very beneficial. You would want to coordinate this with your broker, make sure they're comfortable trying to pay commissions to the S corp. Not all brokers will do that. And so there's planning and things we work to try to assist with to still have it recognized through the S corp. This is not as simple as it sounds. It's not as clean as it sounds. But it can be a very beneficial strategy. But again, coming back to this is why we say it doesn't make sense if you're only earning about $20,000 or $30,000 a year. It's just too much work and compliance for that. If your business is growing, if you have other members, if you have a staff or an assistant who's on payroll, this strategy starts to make a lot more difference or make a lot more sense. I'm trying to watch my time here, guys. I'm sorry, I'm going to start kind of flipping through this. Tax planning continued, retirement accounts for self-employed. There's things called SEPs. Many of you may participate. We love them for our clients. There's IRAs, obviously. Anyone can participate in those. The deductions allowed at certain income levels, or Roth IRAs where there's not a tax deduction allowed, but you get a tax benefit on the back end, and then something called a solo 401k. Advantages is I call it, it's a tax deduction that pays you. What I mean by that is instead of going and buying something you don't need, a new car you may not be ready for, extra expenses, whatever it might be, you're investing. That's all this is. You're investing in what I call your future self. Many of these plans, actually all three I have listed, you can actually make and calculate your eligible contributions to these plans after the tax year. So it's one of the few hindsight tax opportunities there are. So let's say you finish 2020, you're working on your taxes, and you're thinking, man, I've got extra cash. I don't want to send as much to the government. It's a good opportunity to look at these SEPs or an IRA or solo 401k because it's a chance to lower your income after the end of the year. There's just not many opportunities to do that, to let the year close and then still lower your income. However, there's deadlines contributing to these, anywhere from April 15th to basically October 15th. I love these. These are great plans. There are disadvantages. One of them being you can't touch the funds prior to age 59 and a half without that 10% tax penalty we talked about earlier. Now, obviously earlier we went over an exclusion for that that's COVID specific, but that's a general guideline is you put the money into the SEP. Let's say you want to pull it out next year. It doesn't really work well that way. You're looking at income tax and a 10% penalty. So you're paying more on those funds than you would have had you just paid the taxes on the front end. Not all these plans work with the S corp structure that I mentioned above earlier as well. Solo 401k, for instance, doesn't. IRA still can. SEPs can, but they're limited. And if you have other employees like a real estate assistant or team members, not all may want to participate, and they can make those expensive. The other thing I've got here is the type of tax that this addresses is income tax. So whereas the S Corp strategy did not necessarily lower your income tax, it lowered your self-employment tax. These accounts don't do anything for self-employment tax, but they do lower your income tax. Okay, more humor here. So, did you hear the guaranteed way to have $1 million in real estate? It's to spend $2 million. All right, this one's probably my favorite. This may actually get a laugh from somebody. All right, you have a gun with 2 bullets and there's a lawyer, an appraiser, and a realtor. What do? You shoot the appraiser twice. And I'm sorry for any appraisers on the phone. Okay, other tax planning opportunities, children on payroll. This, again, can work very well, but there's compliance and, not necessarily, we do recommend this, but it's one of these, it's not as easy to implement as, say, a retirement plan. So advantages include you're shifting income to a lower tax bracket. You have a child who's, I'm gonna use my example, my 15-year-old son who just had the virus. If he helps me in my firm, he cleans the office, mows the yards here at the office, does office specific work, which he does do some of when I can drag him down here. I can pay him a reasonable salary and him essentially not pay any tax on that because the salary, if it's below, basically up to $12,000 a year, his standard deduction would offset that. Also, certain structures, let's say you're a sole proprietor filing a Schedule C on your individual income tax return and you pay a child, as long as that child's under the age of 16, you don't have to pay in any Social Security or Medicare on those funds. So effectively, those funds go to your child or your household tax-free. No income tax, no self-employment tax or Social Security. We have clients who do this, who have kids set up with retirement accounts. We have clients who have kids who pay private tuition at North Point or somewhere using this. So it's a way of bringing income into the household in the child's name and potentially avoiding all income tax on it. Disadvantages, obviously, these are things that can be scrutinized. If you have children on payroll and you can't justify what you're paying them, you can't show proof of work, the IRS is going to disallow the deduction. And back to what we said on the S Corps as well, additional compliance costs for payroll. Now, this can work for S Corps as well, but it's not as clean. S Corps paying kids still have to withhold Social Security and Medicare regardless of the age of the kids. Sole proprietors accounting for everything on the personal return don't. Tax addressed with this idea, both income tax potentially and self-employment tax. In most cases, the children are going to pay lower income taxes than you will as a parent, perhaps even no income taxes, and have the opportunity to pay $0 in Social Security and Medicare. So you have 3 kids, you have them working with you, they're putting out signs, you're putting them, one of the common things we'll see is marketing flyers. The kids are actively involved in a realtor's marketing, whether it's for flyers or a web-based marketing. They're paid almost like child models, and you document the time and the rate you're paying them. Chance to shift in income that would be taxable to you up to 30 or 40% to someone who in your household to whom it's taxable at 0%. Other tax planning, a couple things here, rental real estate. Many of our real estate clients, realtor clients, own rental property. Rental property, although it's getting harder and harder because of rising rental rates, but rental property can produce tax losses because of depreciation, which we talked about depreciation earlier with vehicles. Those tax losses aren't always deductible by non-realtors. There's special rules that if your income gets above $150,000 as a joint tax return filer, you're not able to deduct rental real estate losses. Realtors, because real estate is considered their occupation, are eligible to deduct rental real estate losses no matter how high their income is. And that's joint income. That's you and a spouse, if that applies. It's also a great investment opportunity. I own rental property myself, and I'm a huge believer in it as an investment opportunity. So special tax treatment for realtors, it may produce taxable income. You may not get any tax losses from it. And look, that's all of our goals, is to invest and make money. I ask the question, is that bad? If you're going into buying rental real estate to generate a tax loss, yes, that's bad. Tax losses are certainly not guaranteed, but if losses do exist, rather than not being able to deduct them and having to carry them forward, realtors have the opportunity to deduct those losses that year. This addresses income tax. It's not a self-employment tax savings opportunity. It's strictly income tax. Okay, just a few final thoughts here before we open it up for questions, particularly for those who are new. Record keeping is, and I don't mean offense to anyone, but is, from what we see, not necessarily our real estate clients' strong suit. You're out there, you're marketing, you're with clients, you're on the phone constantly, and we see a lot of times our clients come in without good records of any sort. So I'm here to emphasize record keeping, at least organizing your information. And if you're not good at tracking things in a spreadsheet or on a QuickBooks, perhaps getting a dedicated bank account so that you can track all your expenses through that and put it together at year end, or work with your tax preparer to put it together. The reason I stress this is not for ease of my job. It's because deductions get missed. If you're going on memory, you're not going to remember what you bought in March. A dedicated business account, whether that be a credit card or whether it be a bank account, will help facilitate that. And of course, certainly if you have an accounting software like QuickBooks or Quicken, one of the web apps, that helps as well. Receipts. We get asked all the time, do I need to keep these receipts? The IRS says yes, so we say yes. We suggest our clients keep their receipts and records for about 5 years. It doesn't have to be beautifully organized. We don't ask for our clients' receipts when they bring their tax information in. We do ask for bank statements, credit card statements, or an accounting system file. We certainly don't want to go through the receipts any more than you do. You can keep them in a folder by month. I set up folders each year that I basically put my receipts in, along with the bank statements and credit card statements. And if I had to go through and organize it by date, I could, but the receipts are in there. I've got a note here that says January's too late. I get the question every time we work on a tax, not every time, excuse me, many times when we work on tax returns, what can I do? And a lot of times the answer is, well, we really needed to ask that question during the year. Other than these retirement plans, there's not much you can do once the year closes. So if you're not thinking about your taxes in October or November, you need to be. Maybe there's things that can be done to help limit your liability. Maybe there's not, but at least you ask the question and you try to do some planning or implement some planning to assist. But once that year closes, once you hit January 1st, there are very, very few opportunities to change your income retroactively. And then estimated tax payments. This is not a way of lowering your taxes. It's a way of smoothing out your cash flow. We have many clients who file the return or hit with a large tax bill. They pay it then and they move on, and they don't speak to me for several months because they're mad. But we encourage estimated tax payments because it smooths out the spending. Instead of trying to come up and scramble or take out a line of credit or something to cover your taxes, you're paying them in quarterly as you go throughout the year, and it really helps manage your cash flow. Like I said, doesn't lower your taxes, and it's hard in real estate to do that because you are in a variable industry. You may have a great quarter and then a dead quarter. So if you're paying in, we have many of our realtors, particularly those who, as we came out of the 2008 through 2013 cycle, who did not want to make estimated payments because, we had all gone through a tremendous market drop. But it does look like with lending rates staying low, I know we're short on inventory in this area, but that real estate will remain strong. And I just would implore you, if there's fear about making estimates, go on and set that to the side. Just because you make them one quarter doesn't mean you have to make them every quarter. You make them as you go. If you had one really good quarter, make an estimate. If the next quarter is bad or down, don't make it that quarter. But it still is better, I think, than making them at the time you file your return, and it will save interest and penalty. Okay, that's the end of it here. I'm going to try to open this chat box here if I can and see what questions. You guys bear with me again. I'm not great with this. Okay. Okay, question here. Are you saying if you purchase in 2020, you already have a vehicle, you can write off the cost if you bought it in 2018? Okay, if I understand this correctly, I'm gonna try to rephrase it. I think what it's being asked is if you have a vehicle in 2020, but you bought it in 2018, you can write off the cost of the vehicle. No, not necessarily. If you start real estate in 2020 and you had a vehicle that you're bringing to the business already, while there is grounds for writing off the cost, you're going to, I believe, come out better. I believe you're going to come out better taking mileage than you would writing off the vehicle then. Trying to read that again, make sure I got that. If you already have a vehicle, you can write off the cost if you bought it. Yeah, I'm not going to call out any names, so I hope I answered that the way you asked it. Is there a weight restriction to the work car that's being deducted? The historical rules actually encourage heavy vehicles being purchased. So 6,000 pounds gross vehicle weighting. Now that doesn't mean the vehicle itself needs to weigh 6,000. I think that includes payload. So you buy a truck, that includes how much it can carry legally in its truck bed. The tax rules have traditionally promoted buying larger gas guzzlers, as they call them, because Detroit is a great lobbyist. These rules now apply to sedans and smaller vehicles as well, but certainly the larger vehicles are more easily eligible for the 1-year write-off. Okay, good question here. If I have an S Corp and have an employee, do I pay employment taxes on them as well? Yes, if you are paying them as an employee, then you do need to pay in Social Security and Medicare that's withheld from their check and that you match. So again, if you have an employee, they contribute roughly 6.2% to Social Security, close to 1.5% to Medicare. You match that as an employer. You're responsible for paying in their portion in your matching portion to the IRS. If you have an S Corp and you're treating them as a contractor, you're not required to pay in employment taxes to contractors. That said, I would caution you about labor laws. I'm not a labor attorney, but you need to look at whether or not they should be treated as an employee. We see that very often with all sorts of industries where contractors will have other contractors working for them. There's specific rules that I don't want to get into and take up 10 minutes, but about employee versus contractor. And if you set up an S Corp, you're going to put yourself on payroll and you have an assistant, you probably need to look at adding them to payroll if you've been paying them as a contractor. Okay, I think I've got a note here. Is a statement okay for documentation? Yes, bank statements and credit card statements. The IRS says you still should keep receipts from credit cards to support credit card statements, but I've never had that as a problem with any examination. They typically are fine to take the credit card statements and the bank statements. Okay. Okay, new realtor here who has not earned any commissions but has spent money on membership fees, board fees. Will that benefit them on their taxes in 2020? Yes, it could. It can help you in 2020, even though you didn't have any income. Now, I'll say this. We don't like to file schedules with no income and all expenses. It's a real easy way to get questioned, especially by Mississippi. Mississippi especially has been questioning those schedules. So if you or your tax preparer is not comfortable with it, and we have become less comfortable with that, even though I do think it's correct for the record, it's just whether you want to fight Mississippi on it or not. What we encourage you to do is consider rolling those expenses to 2021. So if you're only talking about a couple $1,000s, you may just want to avoid the potential exposure and questions and roll those expenses into 2021 when you'd have income. Next question, was PPP included in the new stimulus plan? Yes, a second draw, I think I touched on that, was included. It's much more restrictive than the first time. Many of you guys, unless you had a commission drop during 2020 relative to 2019, you won't get the chance to benefit. It was really geared towards those businesses that had a substantial revenue, gross receipts, commission drop, such as doctor's offices, optometrists, as an example, and restaurants. Can I speak to client gifts? Yes, that's a good question. I cannot remember the exact amount, but generally I think the IRS puts like a 25 or 50 or maybe $75 cap on client gifts. Now we see many of our clients gift something much nicer than that. I'll be honest with you, we let it go through. We're not auditing it. We're not trying to get to the bottom of what every gift you spent was, but the general rule I would say is probably $75 cap on the gift. It's just, you're not likely to get, even if it's questioned, someone's not going to spend any time with it. They wouldn't question you over that, but there is a cap on client gifts. I think $75 is a good rule of thumb, but if you spend more, I wouldn't sweat it too much. Okay, thank you for the person who answered me on the vehicle. I appreciate you letting me know I did answer that. Okay, someone's saying they send their estimated payments in monthly. You guys may all be able to see this, so I'm sorry if you do. It looks like you can. Makes it less painful, and I agree with you on that, certainly. Okay, someone asking about an LLC versus an S Corp. LLCs, just so you know, if and whether there's an advantage. If you weren't here for the beginning of it, I did say that if I were to structure this for a Mississippi resident, I would create an LLC and then tell the IRS through a tax filing form that you want it taxed as an S Corp. If you just set up an LLC and you're the only owner, the IRS is going to treat it as a sole proprietor. So there's no tax advantage there. If you set up an LLC with somebody else, a partner, and you don't tell the IRS you want to tax as an S Corp, it defaults to partnership tax treatment. And there's no advantage to that relative to what you might currently be doing. The only way it works is if you set up the LLC. The only real possible tax advantage is if you set up the LLC and you tell the IRS through a special tax filing you want to treat as a S Corp. Is there tax liability on PPP received? At the beginning, we covered that. I know there were people having trouble getting in. So no, there is not. There's no tax impact from PPP. You don't have to disclose it on your return. You get to write off the deduction. So it's a tremendous win there for everyone. And that may be it. That question just came in a couple minutes ago. Nope, here we go. Home office for write-offs, are you penalized when you sell your home? Good question, really good question. No, you are not. As long as the home office is part of the house. Basically, don't want to go down too far of a rabbit hole, but most of you may know, because you probably have used this with your clients, that you can exclude up to $500,000 of gain from selling your house if you're married, if you live there 2 years. So this person's asking, well, if we write off a part of the home, do we lose the ability to write off some of that gain? As long as the office is adjacent to the home, and we've interpreted that as basically being part of the main house, although we have looked at home offices that are on top of a garage, a detached garage, and we've let that go through as well, then you're not penalized for it. If you've got a separate building that you're deducting as a home office and a shop from the house, then that gets a little bit more squirrely, in my opinion, as to whether you have to reclaim some of that. It wouldn't be much. You're not talking about much depreciation. So what about home office write-off and office space expense? I have an office. That's a good question as well. That's one they're tightening up on, is that if you have a separate office, then if you're questioned on a home office, you very well may have that disallowed. Now, that said, we've defended that before, and we won, because realtors in particular, I mean, let's face it, your car is practically your office. And I'll say this, for last year, if you're off with COVID, there's probably no better time to write off a home office than last year, because many of you, your offices may have closed, or you may not have been comfortable going in, or you may not have been able to go in. So for 2020 especially, the home office is certainly more of an opportunity than perhaps other years, even if you're paying rent to another or you've got an office provided by your broker. Now, that said, many of these offices from the brokers are, you may get a desk and a bullpen is what I think we've called it before. No privacy or anything like that. We let it go through. We've won. We've made the argument that there's enough time served and it's a dedicated space in the house that the home office shouldn't be questioned and shouldn't be disallowed. Then let's see, closing attorney perspective. Does that mean, however, they have to give them a 1099 as opposed to qualifying them for an exemption? Apologize, I don't know the context of what you were responding to on that. Anyway, I'm going to let that one go. They may have been answering to the group. So, guys, I've got about 2 or 3 minutes left here. If there's another question or so you want to shoot it, that's fine. I will say here now, I've got a 11 o'clock I've got to run to, but I wanted to thank you guys for coming on. I hope this was helpful. I hope my jokes made you cringe a little bit. 2 questions back. I'm commenting that I do have to give them a 1099 and report the transfer, not an exemption. Okay, I'm gonna let that one go. She can comment to the group abroad on that. So thank you guys again, and I wish you the best this year. Please stay safe, and good luck with your taxes and as the year goes forward. Thank you.